You know, I want you to picture something for a second. It's October 8th, 2025. Just a regular Tuesday, right? Or at least that's what it looked like on the surface. But in the quiet, dusty corners of the global commodities markets, something was happening that, well, it changed everything. India, a country that just loves its precious metals, places an order, and not just a small order. They put in a request for 1,000 tons of silver. Now, normally, you see an order like that, and the market just absorbs it. It's a big industrial purchase, sure, but it usually happens quietly. Nobody makes a fuss. The metal moves from a vault in London to a vault in Mumbai, and life goes on. But this time? No. This time something broke. I mean, it literally snapped. Within hours of that order hitting the wires, the London silver market, the hub of the wheel, really, it just froze completely. It stopped dead, and then you look at the lease rates. Now, for regular folks, lease rates are it's the cost to borrow metal. Usually it's nothing. It's like 0.25%. It's a rounding error. But overnight, those rates exploded to 200%. Let that sink in. 200%. That's not a market fluctuation, that's a scream for help. That is the system screaming that there is no metal left. And then right on top of that, you have this Swiss refiner, Metalor. These guys are giants, one of the biggest precious metals processors on the planet. They come out and announce, hey, sorry, we can't return any silver until January 2026. They just shut the doors. And at the exact same moment, the US Mint throws up its hands and declares a shortage of silver coins. So, in that single, terrifying moment, a secret that had been buried deep, hidden away for nearly 20 years, well, it became impossible to hide it anymore. And at the center of this storm? You guessed it, J.P. Morgan Chase, America's biggest bank. And let's be honest, a convicted manipulator of precious metals. But here is the twist. This is the part that really gets me. They didn't just get caught with their hand in the cookie jar. No, they pulled off what I would call the greatest financial escape act in modern history. See, between June and October of 2025, while everyone else was asleep at the wheel, J.P. Morgan was busy. They were closing out their entire short position. We're talking about a massive 200 million ounce paper short position. They just wiped it clean. But they didn't stop there. Oh no. At the same time, they were flipping the script. They accumulated 750 million ounces of actual physical silver. Just think about what that actually means for a second. You have the same institution that spent, 17 years suppressing silver prices? I mean, prosecutors literally called it systematic spoofing. These guys made a career out of keeping the price down. And then suddenly they turn around and become the biggest silver hoarder in the world. They didn't just exit their manipulation, folks. They flipped sides completely. And the worst part, or the best part, depending on how you look at it, they left their old friends, their banking co-conspirators, completely trapped in a collapsing short position. They left them holding the bag, losing billions. And look at the price. By December 2025, silver hit $63.95 an ounce. That's not just a record. That is a shattering of legends. We're talking about breaking the 1980 Hunt Brothers peak. You know, the one that generations of traders thought was untouchable? Yeah, that one. Gone. We are talking about the price more than doubling year over year. And the crazy thing is, most investors were just distracted. They were looking at stock market volatility, listening to political noise. They missed the real story. But here is what should really grab you by the collar. 5 major banks are now trapped on the wrong side of this move. You've got HSBC, Deutsche Bank, Scotiabank, UBS. These are the titans of industry, right? And several other former JP Morgan buddies. Collectively, they are holding these massive short positions that are hemorrhaging money. How much? Well, try this on for size. Roughly $179 million for every single dollar silver rises. Let me put that math in perspective for you, just so we're clear. With silver climbing from about $30 in early 2025 to nearly $64 by December, these institutions, they've racked up collective losses exceeding $6 billion. That is not a typo. That's $6 billion with a B. And they are losing it on a metal that most Americans don't even think about. And here's the kicker. Unlike stocks, where you can just sell and walk away, these are derivative contracts backed by physical metal, metal that simply does not exist in sufficient quantities to cover the bets. So they are mathematically trapped. They are stuck in a position that gets exponentially more expensive with every single day that passes. Now, pop quiz. When was the last time America, RS biggest bank, paid nearly $1 billion in criminal fines and then doubled down on the exact same market? The answer is never, because that's not what JP Morgan did. Go back to 2020. They paid a record $920 million settlement for precious metals manipulation. Federal prosecutors proved in court that between 2008 and 2016, they were systematically suppressing gold and silver prices. Thousands of illegal trades. But here is the twist nobody saw coming. Everyone thought, okay, they paid the fine, they'll exit the business. No. They weren't preparing to exit the precious metals game. They were preparing for the end game. If you look at the data from the Commodity Futures Trading Commission, JP Morgan kept these significant short positions in silver markets right through 2024. They were working alongside the same banking consortium they had manipulated with for years. Business as usual, right? Then, something changed. June 2025. It wasn't a whisper, it was a shout if you knew how to listen. Chinese government documents were published ordering all ministries to develop domestic silver mining. They ordered closed facilities to reopen, and critically, they ordered the systematic linking of gold and silver in national reserves. Within weeks, JP Morgan began the most aggressive position reversal in commodities history. Just think about the coordination this required. It boggles the mind. To close 200 million ounces of paper shorts? That means you have to buy back contracts from the people you bet against. It means essentially admitting you were wrong and paying up. But simultaneously, at the same time, accumulating 750 million ounces of physical metal. That means securing actual bars, real coins, getting them from refiners, miners, stockpiles. We are talking about roughly 23,000 tons of silver changing hands in less than 5 months. And the broader market? Completely unaware. How does the world's most scrutinized bank execute a 500 million ounce flip without triggering massive price spikes that would have exposed the move? The answer reveals why that order from India in October broke everything. See, JP Morgan wasn't buying on the exchanges. They weren't going to the public market where prices are transparent and regulated. No. They were securing physical silver through private channels. Forward contracts, strategic relationships built during their manipulation years. They essentially weaponized the same price suppression network they had created. They used those artificially low prices to accumulate metal before the other banks realized what was happening. But, there is only so much physical silver available in the world. Physics is physics. And when India, the world's second largest silver consumer, placed that 1,000-ton order, the market finally ran out of immediately deliverable metal. Here is where it gets really interesting for those of us just trying to protect our savings. Look at the lease rates again. These rates measure the cost of borrowing physical metal for delivery. Under normal conditions, like I said, 0.25 to 0.50%. That's basically the cost of storage and insurance. When those rates spike to 200%, as they did in October, it means there is a severe shortage of metal available to borrow. Refiners like Metalor, they don't announce month-long shutdowns because business is slow. They announce shutdowns because they have loaned out metal they don't have on hand, and they can't get it back from the entities they loaned it to. According to the Silver Institute's 2025 market analysis, global silver supply faces its 5th consecutive annual deficit. 5th, industrial demand alone consumed 1.2 billion ounces in 2025. What's driving that? Solar panels, electric vehicles, military applications, stuff that requires silver's unique conductive properties. But new mine production? It only delivered about 830 million ounces. Do the math, that leaves a structural shortfall of roughly 95 million ounces for the year. Add that to the cumulative deficit of 820 million ounces built up since 2021, and suddenly you start to understand why JP Morgan moved so aggressively. What India's order revealed wasn't just a temporary squeeze, it was proof. Proof that the paper-silver system our financial institutions have operated for decades is breaking under the weight of real-world demand. While other banks maintained their short positions, assuming prices would eventually retreat like they always do, JP Morgan recognized something fundamental had changed. The question we need to ask ourselves is simple, right? If America's largest bank, with access to the best intelligence, the deepest relationships, and the longest manipulation history, If they determined they needed to own physical silver instead of betting against it, what do they know that the rest of us are only now discovering? The U.S. Mint's concurrent shortage announcement wasn't a coincidence. When the primary government entity responsible for producing silver coins tells Americans they can't meet demand, while the world's largest bank is secretly accumulating 750 million ounces. Well, we are watching a profound shift in precious metals markets that most people won't understand until it's too late to act. JP Morgan didn't flip their position because they suddenly became bullish on silver as an investment. They flipped because they received intelligence that the physical market was about to break. And being caught short when that happens? That would have cost them exponentially more than the billions they spent securing actual metal. This isn't speculation. It isn't a conspiracy theory. This is documented position data, verified delivery crises, mathematical supply-demand imbalances. It is creating a situation where the institutions that manipulated silver prices down for 17 years are now facing catastrophic losses because one of their co-conspirators decided to save themselves first. And frankly, we are just getting started understanding how deep this goes. Let's talk about that $920 million fine again. What does that actually mean in the world of banking? JP Morgan Chase paid this record penalty in September 2020 after federal prosecutors spent years building a case. They proved something extraordinary. Between 2008 and 2016, traders at America's largest bank placed thousands of fraudulent orders in gold and silver markets with no intention of executing them. They'd place massive buy orders to drive prices up, then cancel them and sell at the inflated price. Or they'd flood the market with fake sell orders to crash prices, then buy at the artificially suppressed level. Prosecutors called it spoofing, a pattern so systematic, so prolonged, that it could only have been institutional strategy, not rogue traders. But here is what most people missed in the headline coverage. The Department of Justice's case only covered 2008 through 2016. The manipulation didn't stop there. It just got more sophisticated. According to data from the Commodity Futures Trading Commission, JP Morgan maintained concentrated short positions in silver markets through 2023 and into 2024. They were working within the same banking consortium that had collaborated on price suppression for years. What changed wasn't their willingness to manipulate. It was their calculation of when to stop manipulating down and start positioning for the inevitable snapback. Think about the strategic brilliance of what they executed. It's evil, but it's brilliant. For nearly 2 decades, JP Morgan and their co-conspirators kept silver prices artificially suppressed below fundamental value. Every time industrial demand increased or investment interest picked up, massive paper short positions would flood the COMEX exchange. This created artificial supply that overwhelmed real demand. It kept prices contained even as the physical market faced increasing deficits. But artificial suppression creates a coiled spring. The longer you hold it down, the more violently it rebounds when you let go. Now consider the intelligence JP Morgan had access to that other banks didn't fully appreciate. On June 23, 2025, Chinese government ministries published that directive, ordering systematic development of domestic silver mining, reopening closed mines, strategic linking of gold and silver in national reserves. This wasn't subtle. China was publicly announcing their intention to treat silver as a strategic resource in their broader de-dollarization campaign. While Beijing continued exporting record volumes of refined silver to global markets to help keep prices temporarily stable, they were simultaneously accumulating physical metal through state-backed entities that don't show up in Western tracking systems. JP Morgan's position reversal starting in June 2025 wasn't coincidence. It was confirmation. They received intelligence that the game was changing. When a nuclear-armed economic superpower publicly declares a metal strategic to national security, banks with deep intelligence connections understand what's coming. China had been systematically reducing dollar exposure, accumulating gold reserves, and building alternative payment systems for years. Adding silver to that strategic framework meant Western manipulation of precious metals markets was about to face a coordinated challenge that couldn't be suppressed through paper contracts alone. Let's examine what happened on the COMEX exchange itself. This is the primary venue where silver futures trade and where price discovery theoretically occurs. In fall 2024, registered silver inventories stood at approximately 140 million ounces. These are physical bars stored in COMEX-approved warehouses that are available for delivery against futures contracts. By December 2025, those inventories had collapsed to just 116 million ounces. That's a decline of 24 million ounces, roughly 17%, in just over a year. Meanwhile, open interest on silver futures contracts sat at 141,580 contracts, with each contract representing 5,000 ounces. Do that math. 707.9 million ounces of paper claims against 116 million ounces of physical metal available for delivery. That is a leverage ratio of 611%. For every ounce of actual silver available, there are more than 6 ounces of paper contracts claiming ownership. Now, under normal conditions, this works fine because most traders close positions for cash rather than demanding physical delivery. Exchanges operate on the assumption that only about 2 to 3% of contracts ever result in delivery requests. But what happens when that assumption breaks? What happens when even 15% of contract holders decide they want actual metal instead of cash settlement? The math becomes catastrophic. 15% of 707.9 million ounces equals 106.2 million ounces demanded for delivery. But only 116 million ounces exist in registered inventories. And much of that metal is already spoken for through existing delivery obligations and storage agreements. If just 3 months' worth of contract holders decide they'd rather own physical silver than paper promises, especially given the price momentum and supply concerns, COMEX would face the first precious metals default in modern financial history. They literally cannot fulfill delivery obligations without either breaking contracts or somehow convincing holders to accept cash at prices far above spot. This is where JP Morgan's strategy becomes truly ruthless. By accumulating 750 million ounces of physical silver, more than 6 times the entire COMEX registered inventory, they position themselves to profit from the very delivery crisis their manipulation helped create. Remember, for 17 years, they suppressed prices through paper shorts. That suppression discouraged silver mining investment, keeping production artificially low. It discouraged industrial users from building strategic stockpiles, making them dependent on just-in-time delivery. And it convinced most investors that silver was a dead asset, ensuring minimal physical accumulation outside of industrial necessity. Now that the physical market is breaking, JP Morgan owns more deliverable silver than anyone else on Earth. While HSBC, Deutsche Bank, UBS, and Scotiabank maintain short positions expecting prices to retreat. JP Morgan understood something critical. The banks who borrowed physical silver to deliver against their shorts have no way to return it if the entities they borrowed from demand it back. According to Bank for International Settlements data on precious metals, leasing Western banks entered into thousands of lease agreements where they borrowed physical metal at low rates, sold it into the market to suppress prices, and assumed they could buy it back later at similar or lower prices to return it. That assumption just shattered. When lease rates exploded from 0.25% to 200% on October 8th, it revealed that lenders were demanding their silver back, and borrowers couldn't acquire it without driving prices dramatically higher. Swiss refiner Metaller's announcement that they would not return silver until January 2026 essentially confirmed they'd leased out metal they no longer had immediately available. They need months to either mine new supply or buy back metal from the entities they sold to, and doing so at current prices would lock in massive losses on those lease agreements. Here is what makes JP Morgan's betrayal of their co-conspirators particularly calculated. They used their naked short position as a buying weapon. When you hold massive short positions and decide to close them, you're effectively entering the market as a buyer. But if you coordinate that buying with physical accumulation through private channels, you can cover your shorts while simultaneously driving other banks deeper into their losing positions. Every time JP Morgan bought a contract to close their shorts, it put upward pressure on prices, making life more expensive for the banks still holding shorts. And because JP Morgan had already secured physical metal through forward contracts and private deals, they didn't care about rising prices, they welcomed them. The U.S. Geological Survey's 2025 mineral assessment highlights something that should concern every American. Domestic silver production has declined 40% since 2015, while industrial applications requiring silver have increased 78% over the same period. We are consuming far more than we are producing, and that deficit compounds every single year. Solar panel manufacturing alone consumed 202 million ounces in 2025. According to the Silver Institute, a single application using nearly 25% of global annual production. Add electric vehicles, 5G infrastructure, military electronics, medical devices, and water purification systems, and you start understanding why industrial users are panicking. When JP Morgan paid that $920 million fine in 2020, they essentially bought insurance against future prosecution while learning exactly how regulators track manipulation. They didn't stop manipulating, they perfected it. The final phase wasn't suppressing prices forever. It was suppressing them long enough to accumulate the physical metal they'd need when the paper system collapsed. And now they are watching their former co-conspirators face the same fate as every previous attempt to fight market fundamentals with unlimited paper supply. Deutsche Bank, HSBC, UBS, and Scotiabank aren't small institutions. They are global, systemically important banks with trillions in assets. But their silver short positions, which seemed manageable when prices were $20 to $25 per ounce, have become existential threats at $64 per ounce with no ceiling in sight. Every additional dollar in price appreciation represents another $179 million in collective losses. Every day they maintain those positions, the mathematical impossibility of covering them becomes more obvious. And every attempt to close positions by buying contracts drives prices higher, accelerating their losses in a vicious cycle that has no gentle exit. This isn't the first time major banks have been caught in a precious metal squeeze, but it's the first time one of the conspirators decided to escape by abandoning the others. And that changes everything about how this plays out. Let's do some math that should terrify anyone holding paper silver contracts. Right now, silver's 5-year cumulative supply deficit has reached 820 million ounces. That's not an estimate. That's the documented shortfall between what the world produced and what the world consumed between 2021 and 2025. Industrial demand alone hit 1.2 billion ounces in 2025, while mine production delivered only 830 million ounces. We are talking about a structural imbalance that compounds every single year, and 2025 added another 95 million ounces to that deficit. Where did that missing silver come from? It came from existing stockpiles, recycling, and most critically, from banks leasing out metal they assumed they could replace later at similar prices. That assumption is now mathematically impossible. Bank of America published price targets of $50 per ounce by year-end 2025. Saxo Bank projected $36 to $40 in their conservative scenarios. Even JP Morgan's own analysts, the same institution that just flipped long, issued reports suggesting silver could reach sustained levels above $45 before industrial buying accelerates. But here is what those institutional forecasts do not account for: forced covering of the 217 million ounce commercial short position still held by HSBC, Deutsche Bank, UBS, and their co-conspirators. Think about what forced covering means in a market already facing physical shortages. When you hold a short position, you've essentially borrowed an asset, sold it, and promised to buy it back later to return it. In normal liquid markets, covering shorts is straightforward. You buy equivalent contracts and close the position. But silver isn't in a normal liquid state right now. When India's 1,000-ton order froze the London market in October, it revealed that attempting to buy large quantities of physical silver drives prices exponentially higher because the metal simply isn't available in sufficient quantities at current prices. Now multiply India's order by the scale of what trapped banks need to cover. According to Commodity Futures Trading Commission data, commercial shorts collectively need to buy back 217 million ounces. That's 6,150 tons of silver. India's 1,000-ton order broke the market. What happens when banks need to acquire nearly 7 times that amount in a compressed time frame? Analysts who've studied previous commodity squeezes, including the 1979 to 1980 Hunt Brothers silver run, suggest that forced covering in deficit markets doesn't follow linear price progression. It follows exponential curves. The Hunt brothers pushed silver from $6 to $48 per ounce by accumulating only paper contracts representing about 200 million ounces, roughly the same size as the current commercial short position. But they didn't own physical metal, which made them vulnerable to margin calls and regulatory intervention. On January 21, 1980, COMEX introduced Silver Rule 7, a regulation that essentially prohibited new long positions while allowing unlimited shorts. This destroyed the Hunt brothers' paper position, triggering margin calls they couldn't meet. On March 27, 1980, Silver Thursday, prices crashed from $48 to $10.80 as the Hunts were forced to liquidate, eventually declaring bankruptcy. But here's the critical difference between 1980 and 2025. JP Morgan owns 750 million ounces of physical metal that cannot be margin called, cannot be confiscated, and doesn't require daily settlements. The Hunt brothers held paper promises that evaporated when regulators changed the rules. JP Morgan holds actual bars stored in vaults they control, a position that becomes more valuable as the paper system breaks. And the banks trapped short aren't speculators who can simply walk away from losses. They are institutions with fiduciary obligations, derivative exposure, and clients demanding delivery they cannot provide. When you adjust the 1980 peak of $48 per ounce for inflation using Bureau of Labor Statistics data, you get roughly $150 to $180 per ounce in 2025 dollars. We are currently at $64, which means silver would need to rise another 135 to 180% just to match the inflation-adjusted Hunt brothers peak. But the Hunt brothers operated in a surplus market where annual mine production exceeded demand. Today's market faces its fifth consecutive annual deficit, with industrial applications consuming more silver than exists in above-ground stockpiles. The setup for a price spike isn't just comparable to 1980, it's fundamentally more extreme. Consider what's driving demand beyond investment speculation. Solar panel manufacturing consumed 202 million ounces in 2025 and is projected to grow 25% annually through 2030 as countries accelerate renewable energy transitions. Every solar panel requires 20 grams of silver for conductivity. That cannot be substituted with cheaper alternatives without significant efficiency losses. Electric vehicles used 72 million ounces in 2025, with each EV requiring nearly twice the silver content of traditional vehicles for electrical systems, charging infrastructure, and battery management. 5G infrastructure deployment consumed 38 million ounces for high-frequency signal transmission that requires silver's superior conductivity. But here is where it gets really concerning for American national security. Military applications consumed 24 million ounces in 2025 for missile guidance systems, radar technology, communication equipment, and next-generation weapons platforms. The Pentagon cannot substitute copper or aluminum in these applications. Silver's unique properties are mission-critical for systems that need to function in extreme conditions. When JP Morgan accumulated 750 million ounces while other banks maintained shorts, they essentially cornered the market on a metal that's strategic to everything from renewable energy to national defense. Now let's talk about timing, because the window for retail investors to act is compressing rapidly. The Federal Reserve cut interest rates by a quarter point in December 2025, a decision that signals concerns about economic slowdown while inflation remains elevated. Lower interest rates reduce the opportunity cost of holding precious metals that don't pay interest or dividends. But more importantly, the incoming Trump administration has signaled intentions to implement significant tariffs on imported goods, particularly from China. Every economic analysis of tariff impacts shows the same result. They increase domestic prices, which translates to higher inflation. Higher inflation combined with lower interest rates creates the perfect storm for precious metals demand acceleration. When people lose faith in currency purchasing power, they historically move to assets with intrinsic value. Gold hit new record highs in 2025 for this exact reason. But gold's price is already $2,800+ per ounce, making it inaccessible for many retail investors. Silver at $64 per ounce offers similar inflation protection with a lower entry point, which is why retail demand for physical silver coins and bars has exploded even as most investors remain focused on stocks and bonds. Here is the mathematical progression that should concern anyone who hasn't already positioned in physical silver. Current price is $64. Conservative institutional targets suggest $80 to $100 by mid-2026 based purely on supply-demand fundamentals. But add forced covering of 217 million ounces of commercial shorts, and analysts, who've modeled similar squeezes, suggest prices could spike to $100 to $150 per ounce by Q1 2026, if even 5% of COMEX contract holders demand physical delivery during the December-January settlement period. Historically, these are the heaviest delivery months. The exchange would face delivery failures that could push prices above $200 as industrial users panic buy outside broken futures markets. Swiss refiner Metalor already announced they won't return silver until January 2026. That's not a temporary production delay. That's an acknowledgement they've committed metal they don't currently possess and need months to acquire it. December through January represents COMEX's primary delivery period, when most futures contracts that demand physical settlement come due. If Metalor, one of the world's largest precious metals refiners, cannot deliver on commitments until January at the earliest, what happens to the thousands of other delivery obligations coming due in the same timeframe? The COMEX exchange has mechanisms for handling delivery failures. They're called cash settlements. Essentially, if the exchange cannot deliver physical metal against a contract demanding it, they offer cash payment at spot price plus a small premium. But those mechanisms were designed for occasional isolated failures, not systemic breakdowns affecting hundreds of contracts simultaneously. More importantly, cash settlements destroy price discovery. If investors can't trust that buying a silver contract actually gives them the right to receive silver, they'll stop trading on that exchange, and physical premiums will disconnect entirely from paper prices. We are already seeing early evidence of this disconnect. Physical silver coins from the U.S. Mint now trade at premiums of 25 to 40% above spot price, meaning if spot is $64, actual coins cost $80 to $90. That premium reflects the market pricing and delivery risk and physical scarcity that paper prices don't capture. When premiums reach 50 to 100% above spot, which happened in previous silver squeezes, it signals that paper prices have become meaningless for anyone trying to acquire actual metal. At that point, industrial users who need silver for production will pay whatever's necessary, driving physical transaction prices far above any exchange-quoted spot. Let me put the opportunity and the risk in perspective for those of us just trying to protect our purchasing power and make informed investment decisions. If you're holding paper silver ETFs, futures contracts, or certificates that promise you own silver without giving you physical possession, you're exposed to counterparty risk that's becoming more dangerous by the day. When JP Morgan flipped from short to long, they didn't buy more ETF shares. They accumulated physical bars. When China issued that June directive treating silver as strategic, they didn't increase paper exposure. They ordered domestic production and physical accumulation. The institutions with the best intelligence and the longest manipulation history are choosing physical over paper. That should tell us something about which form of silver ownership will maintain value when the paper system faces delivery failures. And those failures aren't hypothetical future concerns. They're happening right now. India's October order froze markets. Metalor suspended returns until January. The U.S. Mint declared shortages. Lease rates spiked 800-fold overnight. These are not signs of a healthy functioning market. These are warnings that the physical supply chain is breaking under stress that will only intensify. The Hunt brothers tried to corner silver with 200 million ounces of paper contracts and lost everything when regulators changed the rules against them. JP Morgan accumulated 750 million ounces of physical metal, more than 3 times the Hunt position, and positioned themselves to profit when regulators inevitably have to acknowledge the paper system cannot deliver on its promises. The difference between those two outcomes isn't luck. It's understanding that physical possession beats paper promises when markets break. For Americans watching our currency lose purchasing power, our stock market reach valuation levels that defy fundamental analysis, and our government add trillions to national debt that our children will inherit, precious metals represent one of the few assets with intrinsic value that cannot be printed, diluted, or defaulted on by institutions. Silver specifically offers that protection at a price point accessible to regular investors who do not have $2,800+ for a single ounce of gold. But accessibility only matters if you can actually acquire it. The window between recognizing a supply crisis and being able to act on that recognition is closing rapidly. December through January is historically when COMEX delivery pressures peak. Swiss refiners are already out until January. The U.S. Mint is already experiencing shortages. If even a small percentage of investors reach the same conclusion JP Morgan reached in June, that physical silver is preferable to paper promises, premiums will spike beyond what most people can afford, and available supply will disappear entirely from retail channels. This isn't fear-mongering or pressure to make rash decisions. This is mathematical analysis of supply deficits, documented institutional positioning, and observable market breakdowns that point to the same conclusion. The paper-silver system that's operated for decades is facing structural collapse. Those who understand that reality have the opportunity to position before the broader market recognizes it. Those who wait for mainstream confirmation will find themselves trying to buy at prices and premiums that reflect panic rather than prudent preparation. JP Morgan spent 17 years manipulating silver prices down, paid $920 million in fines for doing so, then flipped to accumulate the largest physical position in history. They didn't make that move because they suddenly became bullish on silver as an investment. They made it because their intelligence told them the game was ending. And being caught short would cost infinitely more than the billions they spent securing physical metal. The banks still trapped short are learning that lesson in real time, losing $179 million per dollar of price appreciation with no mathematical path to exit without accelerating their losses. And we are watching it unfold with enough advance warning to make informed decisions about how we protect our wealth before the crisis fully breaks.